In Northern Europe, flying the nest at 20 is a rite of passage. Down south, staying put into your 30s just earns you the label of a lazy mama's boy. But is there any truth to this cultural stereotype? Or is a brutal economic reality trapping millions of young Europeans in their childhood bedrooms? Today, we're ranking the absolute best and worst countries in Europe for youth independence. While we'll focus mostly on the EU, we're also going to reveal some shocking data from the wider continent. And since unfair taxes are partly to blame for this mess, if you want a video on the European countries with the highest taxes, just type Europe in the comments below. Welcome to Amazing Europe. Number 5 among the best, the Netherlands. Actually, if we look just outside the EU, the true number 5 would be Norway, at 22.7 years old. Norway achieves this incredible speed not just through jobs, but because the Norwegian state operates a public housing bank. This bank gives specialised mortgages directly to young people, acting as a massive financial shield against private banks. But looking only at the EU, in 5th place we find the Netherlands. Here, young people leave their parents' home at an average age of just 23.2 years old. How do they do it? You might think they all land high-paying corporate jobs right after graduation. But the truth is much simpler, and it starts when they are teenagers. The secret lies in a system that forces young people into the labour market early, rather than keeping them isolated in schools. In the Netherlands, youth employment is staggering. According to Eurostat, almost 80% of Dutch youth aged 15 to 29 are employed. This is the highest rate in the entire European Union. They achieve this through a specific law called jeugdloon, or the youth minimum wage. This system allows companies to legally pay teenagers a lower age-adjusted wage. This makes it highly profitable for businesses to hire 16-year-olds for part-time jobs. But here is the real difference compared to the rest of Europe. These are not unregulated, under-the-table jobs. In the Netherlands, a part-time contract gives you real legal protection. It builds your pension. It gives you a formal, verifiable work history. By the time a Dutch student is 22, they already have 5 or 6 years of official employment. When they walk into a real estate agency, their part-time contract is often accepted as a valid financial guarantee to rent a room or a small apartment. The system treats them like young professionals building equity step by step. They are financially independent before they even get their university degree. So, the Netherlands proves that early, protected access to the job market is the key to independence. But what happens when an entire nation uses short-term contracts to exploit the youth? Let's fly south to our number 5 worst country. Number 5 among the worst, Spain. In Spain, the dream of independence crashes against a brutal reality. Young people cannot leave their parents' home until they are 30 on average. If the Netherlands is a machine built to integrate youth into the economy, Spain is legally designed to keep them out, with youth unemployment hovering around 25%. The real trap is a 2-tier legal system. Older workers enjoy permanent contracts with ironclad protections, making them almost impossible to fire. To balance this, companies use young people as disposable labour through contratos basura, junk contracts. A young worker might be hired for 3 months, fired to avoid benefits, and rehired later. Furthermore, while Dutch law allows 15-year-olds to work to build early financial independence, Spanish law forbids paid work before 16. As if precarious jobs weren't enough, there is a final trap: taxes. Spain recently introduced the intergenerational equity mechanism. Despite its noble name, it is a permanent payroll tax increase. Instead of reducing older workers' pensions, the state forces today's precarious youth to pay higher taxes immediately to keep the system afloat. When rent consumes up to 70% of your income, combining junk contracts with rising taxes mathematically traps you in your childhood bedroom well into your 30s. Number 4 among the best, Estonia. Now we find a Baltic powerhouse that completely reinvented its economy, Estonia. Here, the average age to leave the parents' home drops to a remarkable 22.4 years old. Estonia proves that you don't need centuries of accumulated wealth to get young people out of the house. You just need a smart banking system and a digital-first economy. Estonia has one of the highest home ownership rates in Europe, and they actively push young adults to become owners early on. How? By bypassing the down payment trap that paralyzes the rest of Europe. The Estonian government operates a state-backed financial foundation called Kredex. This institution provides direct guarantees for housing loans, specifically targeting young professionals and young families. Instead of forcing a 25-year-old to save 20% of a home's value in cash, which could take a decade, the state guarantees the loan, dropping the required down payment to as little as 10%. Combine this state-backed credit system with a booming tech sector that hires young people fast and pays them well, and you get a perfect recipe for early independence. In Estonia, banks are not looking for wealthy parents to co-sign a mortgage. They look at the young worker's income and the state's guarantee. The system actively bets on the future of its youth, rather than demanding they rely on the past wealth of their families. They trust the young to build the nation. Having the state act as your financial guarantor is an incredible advantage. But in Southern Europe, the guarantor sitting next to you at the bank almost always has white hair. Number 4. Among the worst. Italy. In this G7 manufacturing powerhouse, young adults cannot leave their childhood bedrooms until an average age of 30.1 years. If Estonia is a system built on state-backed financial trust, Italy operates as a strict financial gerontocracy. In the Italian banking system, your talent, your degree, or even your standard job contract are rarely enough to secure a mortgage. Here, this missing decade is strictly enforced by the banks. Italian credit institutions are notoriously risk-averse. To buy a house, they demand a substantial cash down payment, money that young Italians simply cannot save because their entry-level salaries are structurally too low. So what is the Italian solution? The intergenerational guarantee. In Italy, if you want a house in your 20s, your parents must either give you tens of thousands of euros in cash or physically come to the bank to co-sign your mortgage, putting their own pensions or properties on the line. This creates a devastating social divide. If your family is wealthy, you get a house. If your family is working class, you are financially locked out. You cannot buy, and because the rental market is severely overpriced, you cannot rent either. The Italian banking system treats a 28-year-old worker not as an independent adult building a future, but as a financial liability who must be sponsored by a parent. It is a system that mathematically forces a generation to delay adulthood for a decade. Number 3, among the best. Sweden. Here, young people manage to leave their childhood bedroom at 21.9 years old, making it one of the earliest exits in Europe. But the Swedish story is unique. Unlike Estonia, which relies on state-backed mortgages to push you to buy, Sweden relies on a massive, highly regulated rental market. For over a century, Sweden has operated under a strict system of rent control. Rents are centrally negotiated by powerful tenant unions based on the utility value of the apartment, not on what the free market demands. In theory, this protects the middle class and youth from aggressive real estate speculation, blocking the sudden rent spikes that crush young workers. However, this protection comes with a harsh side effect: massive waiting lists. In Stockholm, waiting for a first-hand rent-controlled apartment can take over a decade. Because older generations refuse to give up these cheap contracts, young Swedes are often forced into an expensive, short-term, second-hand subletting market. Yet, despite this flaw, young Swedes still leave home at 21. Why? Because in Swedish culture, independence is the absolute, non-negotiable rite of passage into adulthood. Combined with strong state subsidies for students, this mindset changes everything. A young Swede is culturally hardwired to accept living in a tiny 15 square metre room, or moving 3 times in 5 years, just to get out of their parents' house. In Sweden, independence is not something you wait for. It is something you claim at all costs. But what happens when the culture is different and you open the real estate market to aggressive global investors? Young locals become refugees in their own cities. Number 3 among the worst, Greece. Here, a devastating mix of global capital and low wages keeps young adults living with their parents until an average age of 30.7 years. Together with Spain, it is the only country on this list in which this figure has increased over the last 10 years. Unlike Sweden, where the state heavily regulates the housing market, Greece opened its doors to massive foreign investment to recover from its debt crisis. They launched the Golden Visa program, allowing wealthy foreigners to buy Greek residency by purchasing local real estate. Almost overnight, billions of euros poured into Athens and Thessaloniki. Entire apartment blocks were bought by international funds and converted into luxury properties or short-term Airbnb rentals for tourists. For the Greek economy, this was a massive influx of cash, but for young Greeks, it was a disaster. As affordable apartments vanished, local rent prices exploded by up to 40% in just a few years, completely detaching from local wages. Faced with a booming tourist housing market and chronically low youth salaries, young Greeks had nowhere to go but back to their childhood bedrooms. And here, culture plays a huge role. Unlike the strict individualism of the North, Greece operates on strong family bonds. In southern Europe, the family is the ultimate safety net. Historically, parents would help buy a house for their children when they got married. But since the crisis wiped out family savings, the only help parents can offer today is a roof over their children's heads. In Greece, staying with your parents is not a lack of ambition, it is a forced economic shelter. Number 2 among the best, Denmark. Here, young people leave their parents' home at around 21.7 years old. That is one of the lowest ages in all of Europe. Denmark did something most countries never dared to do. It treated housing not just as a private investment, but as a shared social good. Instead of choosing only between renting and full private ownership, the Danes built a third option in the middle. The first pillar is their huge non-profit housing sector, called Almene Boliger. About 1 in 6 Danes lives in these homes. Rents are cost-based and non-profit. They cover maintenance and loans, but nobody is allowed to speculate on them. There is no income limit. Students, workers, and low-income households can all access the same buildings. The second pillar is the andelsbolig system, the Danish housing cooperatives. Instead of buying an apartment, you buy a share in a cooperative that owns the whole building. That share gives you the right to live in a specific flat and to vote on how the building is managed. Historically, the price of these shares has been capped by law and internal rules, which kept them far cheaper than regular condominiums and made it possible for young people to buy into good neighbourhoods without rich parents or huge savings. Even though some central co-ops have become more expensive today, this model remains a crucial entry point. In short, Denmark built an entire ecosystem that lowers the entry barrier to independent living. Housing policy writes the destiny of a generation, and the best proof comes from 2 countries that once were exactly the same state. Number 2 among the worst, Slovakia. Here, young adults leave their parents' home at an average age of 30.9 years, one of the latest in Europe. What makes Slovakia so important for our story is that it is part of a natural experiment. Until 1993, Slovakia and the Czech Republic were the same country, with the same language group, a broadly similar cultural background, and the same socialist housing legacy. Today, however, the outcomes for young people are completely different. In the Czech Republic, the average age of leaving home is 25.8 years. In Slovakia, it is almost 31. The reason is not mentality, it is concrete policy. Studies comparing construction show that in the 2000s, Czech regions built hundreds more dwellings per year than Slovak regions. In other words, the Czechs kept building while the Slovaks fell behind. Journalists describe Bratislava as a city with no apartments. There is a chronic shortage of both owned and rental housing, very little social housing, and rapidly rising prices. Many young Slovaks remain in multi-generational households or stay in relationships and shared flats they would otherwise leave, simply because they cannot afford to live alone. Prague is far from perfect. Prices are high and investors are active, but there is at least a real rental market and more diverse housing options. As a result, only about 29% of Czechs aged 25 to 34 still live with their parents, compared to more than half in Slovakia. 2 ex-cousins, a broadly similar culture, 2 housing systems, and a 5-year gap in the age at which young adults are finally allowed to start their own lives. Number 1 among the best, Finland. We have finally reached number 1 on the best side, Finland. Here we find the absolute European record. Young Finns leave their parents' home at the incredibly early age of 21.4 years. How is this possible? Finland represents the perfect ecosystem, proving what happens when a country actively plans for the future of its youth. It starts with culture. In Nordic societies, early independence is a fundamental expectation. But unlike other countries that demand independence without providing the tools, Finland backs it up with massive institutional support. The Finnish welfare state provides generous student grants, student loans, and direct housing allowances. This means a 20-year-old does not need a full-time permanent contract to afford a roof over their head. But the real magic happens in the housing market, particularly in the capital, Helsinki. The city operates a hyper-efficient network of non-profit housing foundations. Organisations like HOSE, the Student Housing Foundation, provide tens of thousands of subsidised below-market apartments exclusively for young people. They don't banish students to isolated suburbs. Finnish urban planning mixes student housing, social rentals, and private apartments in the exact same neighbourhoods. They even build generational blocks where young students and the elderly live together, sharing facilities. In Finland, early independence is not a risky leap into poverty. It is a fully supported transition. The state invests in young people the moment they finish high school, treating them as the most valuable asset the country has. Finland proves what happens when a country plans for the future. Our absolute worst number 1 instead shows what happens when a nation surrenders to global markets and simply gives up, leading to total demographic collapse. But before we reveal it, if you're finding this video informative, please support our project by leaving a like, subscribing to the channel, and hitting the bell icon to turn on all notifications. It's a simple gesture, it's completely free for you, but it truly makes all the difference for us. And remember, if you want a video about the European countries with the highest taxes, type Europe in the comments below. Number 1 among the worst, Croatia. Our number 1 among the worst countries is Croatia, where young adults cannot escape their childhood bedroom until they are 31.3 years old. To put this into perspective, there is a 10-year gap between a young Finn and a young Croat. A decade of independence lost. And if we look beyond the borders of the European Union, we discover that the absolute record belongs to Montenegro. Here, the age of leaving home skyrockets to a staggering 33.3 years. It should be noted that this specific figure dates back to 2020, while all the other data we've seen are updated to 2024. Both Croatia and Montenegro suffer from the exact same fatal disease, the collision of Balkan wages with increasingly Western real estate prices. In Croatia, more than 80% of young people aged 16 to 29 still live with their parents. Why? Part of the answer, and we repeat, only part of it, is that the country has handed over its housing market to mass tourism. Beautiful coastal towns like Split or Dubrovnik have seen their local apartments swallowed by short-term rentals and foreign buyers. Real estate prices are geared toward wealthy tourists, while local youth are paid Eastern European salaries. With no state housing support and rents totally disconnected from local incomes, the family remains the only safety net. But this late exit has devastating macroeconomic consequences. If you don't have a house, you don't form a family. If you don't form a family, you don't have children. Today, Croatia is facing a brutal demographic winter. Unable to afford a future at home, the brightest young minds simply pack their bags and emigrate to Northern Europe. Ultimately, this 10-year gap across Europe isn't just about laziness. It's the result of a perfect storm: stagnant local wages, skyrocketing housing costs, broken welfare systems, and a deep-rooted Mediterranean family culture that acts as the only social safety net. But what do you think? What are the real causes, in your opinion? Let us know down below. Leaving home a decade later means starting a family a decade later, with catastrophic demographic consequences. To see where this leads, watch the video on screen about Europe's 10 lowest birth rates. That's all for this video. See you next time.